individuals, the sole proprietors, US and Canadians, citizens who may have filing responsibilities cross-border, but also, for an individual who has a little bit more of a complex tax situation in Canada and wants a little bit of help, wants some help preparing the return, or even just wants to consult, that's my bread and butter. I like dealing one-on-one with the individuals. When you talk about clients, I find my clients, I'm building relationships, I'm making friends. So that's why I'm doing what I do. I do what I do. And that's one of the reasons why I'm here today. Beth, we introduced each other on Alignable, and when she found out what I did, she asked me to do a little bit of a talk here today. There we go. So, I enjoy taxes, and a lot of people don't, okay? Hence the name, The Joy of Tax. Today I'm giving you a little bit of presentation. It's tax tips for sole proprietors, which my understanding is basically the fact that with Fox Life, you're independent sales contractors, sole proprietors, and therefore you have the additional reporting requirements as a sole proprietor. But we'll talk a little bit about what makes a sole proprietor as we go along. And of course, there's presented by me. Okay. Now, what is a sole proprietorship as compared to an employee or a commissioned salesperson? You're basically dealing with is a sole proprietorship, unincorporated business owned and managed by one person. Okay? Its characteristics are one person has the responsibilities for making all the decisions. The owner receives all the profits and responsibility for losses. And the owner is considered self-employed and reports the business income on their own T1 tax return here in Canada. Okay? And that is the Schedule 2125, for those of you who may not be familiar with it, reported business activities. When you're looking at what is considered self-employment income, obviously your gross business or professional income, and that's the total of all sales, revenues, other fees related to business activities, including income from e-commerce. So if you're on the internet and you're making sales, those are taxable income in Canada, even though the person buying it may be in Timbuktu, that sale is in Canada. So you have to report your worldwide income on your Canadian tax return, okay? Net self-employment income, okay? So basically your gross business income is all of it, okay? Every single thing that you've taken in. Your net self-employment income before adjustments is achieved by taking that gross income and deducting expenses. And what I found a lot is when it comes to people who are self-employed, they're not sure what they can deduct. They're not sure what percentages, they're not sure what they can take off their tax return, they're not sure. So we're going to be getting into that in a little bit more detail. Yes?
Something? So I've always thought that network marketing, you record your income on that commissions line. Is it not commissions? From what you just said, commissions versus self-employment?
Depending on your contract with the direct supplier, it depends on how you're handling it, because a lot of times what you are is an independent sales contractor.
Okay, but
so that would be a 2125.
Yeah, but
okay.
There's a line that says commission income.
Yeah, and usually it's not. Usually it's self-employment income from direct marketing. You can consider it commissions from the company, but in a lot of ways, as a sole proprietorship, you can actually claim more deductions as a sole proprietor rather than as a commissioned income salesperson.
I did not know that. Okay.
And usually commissions are achieved from an employee who's working on sales commissions from their employer. So they have they have their total income of $100,000, of which $500,000 is from, or $50,000 is from their commissions, and the rest is wages.
So there's a line for self-employment income as opposed to and commissions.
Yes, when you're looking at when you're looking at your tax return, the T1 folder, what you're looking at is actually the 2125. Now, so in your case, I would say that when you find out what your business level is, create it as a self-employment income rather than as a commission. Because a commission usually implies an employer-employee benefit relationship, rather than an independent sales contractor is somebody who is self-employed.
Interesting. Good to know. Okay.
Mm-hmm. There's certain deductions on commissions you can't take.
Didn't know that.
Okay. Yeah. Okay. So taxable self-employment income is determined after applying additional adjustments to that income, and of course your business use of home expenses. Okay. And that's where you get your taxable self-employment income. So you're basically, when you're doing your tax return, you're going through two different levels. You have your gross, your net, and your taxable, okay? These different levels have different implications with regards to reporting requirements, HST, and various other things. So it's important that you kind of have an idea of where those levels are, okay? Okay. When it comes to income, you track income separately for each business or professional activity you are involved in. So if you are involved in Box Life, that's one business. Avon, that's another. Okay, they're different items. So you would actually have to track each one separately because they're different reporting requirements. Okay, you can't hold your employment activities for different activities. For example, I'm self-employed as an accountant. If I were to join Box Life, that would be a separate tax filing because it's a different purpose, different business code, okay, for that type of an activity, okay? Income generated from website activity, for example, if you have established a website where people can actually buy and sell from your website, should be tracked separately. So it's part of your gross income, but you should be tracking that separately as well because there are additional reporting requirements for income earned from a website. Now, if it's just an informational website, so people aren't placing orders to the website, but to go on the big screen, a company like Amazon, they gotta track their website income. Actually, that's more their main source, but small proprietorships, people from Walmart, am I ordering through the web or I'm ordering through the store, they gotta keep those tracked separately. As a sole proprietor, you should keep those separately as well. There's a different place to report that on the tax return. Personally, I have just an information webpage, it's still in development, so I don't have to worry about it, but that is a concern, okay? Services.
Through our Box business though, people are placing an order through the Box website, so that is website, but it's still, we get commission on that, so so we just have to record the commission that we earn, right?
You just have to record the commission that you earn. It's not your website. What they're looking for is your individual website. So if you have product in your home or that you purchase for resale, like to sell, not through the website, then that would be more of tracking the website from that. Yes?
So if you have your own website, but it just loops them into the Box Life website, then that's
That's totally different. Yeah, that's totally different.
Yeah.
Yeah, rather than having the website, because you have 10, you kind of, instead of taking one sample, you ordered 100 samples or 100 of these things, and you have them sitting in your back room, and you need to sell them, and that's that's the difference. Okay. If services or goods provided for compensation from a barter transaction are income. Okay. A lot of people like to, that under the table, the underground economy, I'm going to provide you tax services, you're going to give me 500 patches. I know that's kind of unreal, but the thing is, for both of us, that's an income transaction. So the fair market value or the remuneration for the services provided, I need to record that as income, okay, on my tax return, okay, and vice versa, okay. Of course, the expense as well is the obsessive, but you really have to deal with on a gross income basis. Okay, so we figured out how to calculate our gross income. All right, we've got an idea where that is, and we're now panicked because we're expected to pay tax on all of that. Of course, as a sole proprietor, you're responsible for Canada pension deductions and EI deductions for self-employment if they are applicable, if you opt into that. You're also responsible for income tax. As a general rule, I usually tell people squirrel away at least 30, depending on where your income threshold is on your other income, squirrel away about 30% of your gross income. Just put in the bank. As you proceed and if you're paying CPP, you may have to do quarterly payments, and you have the money to make those payments. Otherwise, you will get hit with CPP at the end of the year. And unless you've made installments, you may have a payment in April. So then you have the money set aside for both income taxes and payment. If you've saved too much, great, that's your money. But I usually recommend about 30%, especially if you have no history. Okay, and that comes from the tax brackets, 15 and 5 for Ontario. Okay, so it's a 20% tax, federal and provincial for the basic tax rate, and then the CPP percentage and the EI percentage for a sole proprietor, which amounts to almost another 10%. Okay, so that's the minimum. Expenses reduce that gross income, and these are examples of some of the expenses that you may find. We have purchase of samples. Remember to keep the record of those because they're tax deductible. Advertising, travel, office supplies, your insurance, home phone, cell phone, conventions, software, meals, entertainment. There's a whole list of them, okay? And that's, like I said, it's this there. You'll notice some of them are asterisks there. That's because there's maybe special considerations on how they can be claimed. As a sole proprietor filing a T1 tax return with the statement for business income, you have to work on a cash-based business. So expenses are deducted in the year incurred, okay? You do not have the ability to accrue. Sales are recorded when the cash is received in your hand. Expenses are incurred when paid, okay? If you're paying for more than a 12-month period, you may have to offset a little bit of that, but most of the time we're working within that 12-month period, okay? There are certain exceptions, but as a general rule, cash in, cash out. So if you have a sale and you don't get paid for it till January, January is when you receive the cash, you have access to the check, that's fine. If you have a sale and you get paid on December 31st, you have the check in hand, but you haven't deposited in the bank, that's still income received on December 31st, because you have the fact that you didn't make it to the bank, that's you still had access to that check. If you get a post-dated check for January, it's a little bit different. That's January because you don't have access to your deposit until January. Just as an example. When you're coming to, your business, this is why we get differences between what's a taxable income for business purposes and what your actual income is on the sole proprietorship per se, because certain things you can't deduct for tax purposes, okay? Samples, you're good, deducted in the year of purchase, not when you give them away, but when you buy them, okay? Travel expenses, you're only limited to deduct 2 conventions a year. So for example, if Box Life has a big convention, you can go, you can deduct those expenses. If they have 3 of them, you can only deduct 2. You may go to the 3rd, but for tax purposes, you can only deduct 2, okay? If you go to somebody else's convention, say Amway, no way, but anyway, then you can deduct that one because it's not related to what you're doing. You can go to other conventions. So if you go to other seminars, other trainings, those can be deducted.
So
Okay.
so this meeting today is not really a convention, if you will. And if I do 5 of these in a year, can I claim all 5 of them for travel? Like for mileage?
Mileage and travel and that type of thing, definitely, yes.
Okay.
Okay.
It's the convention fee.
But if you're going away for a weekend convention kind of thing, where,
It's a hotel and
that's what,
hotel.
what the definition of what a convention is versus a like a get-together or a training, or that type of a thing.
Okay.
Okay, so it depends on how it's qualified, okay? Let me just double check my note here, see if there's anything else. Okay, yeah, so, some of them in the asterisks is because we might have to deal with a proration. For example, what is the insurance for? You can't deduct insurance on your boat as a business expense, obviously. It's got to be business related. So we're basically dealing with business related expenses. One of the exceptions here is meals and
business on your boat?
Huh?
Doing business on
We'll talk about that. We'll talk about
That's my socks on the dock.
yeah. Meals and entertainment are one of those where the business expenses versus what you can claim tax-wise are different. As a sole proprietorship and I take people out for lunch, I'm spending $100 on lunch, okay, if I'm taking 2 people out for lunch, whatever. From a tax perspective, I need to keep the receipts for the $100. But on the tax return, it's reduced by half. So the deduction is only 50%, okay? That depends on whether you're doing it for, you're taking 1 person or 10 people out for lunch, you're only allowed a 50% deduction for meals and entertainment. You can't deduct the whole expense on your tax return. Some things may have to be depreciated versus expensed in the current year. That depends on how much you spend on those expenses. So a few tips regarding expenses and recording them. Got a little tip there. But if you look, expenses should be related to the business activity. I kind of already mentioned that. You retain your receipts. Record keeping is extremely important, okay? So retain your receipts. As a side note, if you have one of those disappearing receipts, i.e. a thermal receipt, you may want to scan that or photocopy that, because if that disappears and you pull it out and it's a blank piece of paper, because you know they disappear over time, right?
Yeah.
You won't have that backup in case the Canada Revenue Agency decides they want to see the receipts for some reason. Okay, so it's always good to do that. I also recommend that you file things on a regular basis and file them by month and by expense type, so that if you need your entertainment expenses for January, they're right where you can grab them. Okay, if you're not dealing with a lot of receipts, then at least have them by month. Okay, and keep them current. Now, when it comes to meals and entertainment, record on the receipt who you had lunch with and the purpose of the meeting. Because that way you can remember later if they were to question the meals expense. And the receipt should be for at least 2 people, okay? You can't claim your own lunch if you're, whatever, like as a regular thing. If you're away for the day, like today, it's a little bit different. But if you are working from home, and you go out and get lunch and come back, not a business expense. Okay? All right. Keep your records updated. So whether you're a paper person or an Excel spreadsheet or LibreOffice, whatever you do, keep that spreadsheet up to date recording, because the last thing you want is trying to go through 3 or 4 months worth of receipts in time for the tax deadline. Of course, one of the benefits of a sole proprietorship is you do have till June to file. Okay. If you have self-employment income, you have until April 30th to pay if you have a balance owing. But the actual filing of a person who's a sole proprietor, their tax filing is not due until June. And that goes for your spouse too. So you have a little bit of a wiggle room there. It doesn't give you an extension on amounts to pay, just on filing. Items that have a useful life of more than 1 year could be considered a capital expenditure, like you bought a new desk. It's not going to be used up in a year. So when you look at something that is more permanent or has a prolonged use, software, sometimes computer, hardware, a desk for the office that you're buying for business purposes, you have to look at it a little bit more carefully and see if this is something that I can expense in the current year. And if it's under $250, expense the silly thing. But expense it. But if it's a costly expense, you may have to look at depreciation, which basically means you have to spread the cost out over a period of 5, 7, 10 years. And that's where, people can get a little bit mixed up. Okay. This also applies to repairs to the house. If it's something that's just fixing it versus I'm putting a new roof on, whether you can expense a portion of that to your business. Okay. Anyone have any questions? Just kind of put your hand up as we're going along. I don't want to. So I'm going to flip to automobile expenses, because even though we're mostly working from home, we do have a vehicle and we do tend to use it to go meet people, meet clients, etc. So automobile expenses and any expenses dealing with your automobile are kind of like handled in a different category than just your normal business expenses. Okay, I go to the BD's and I buy a ream of paper for my printer. Yeah, that's a business expense. But I put gas in my car, and then I go to see a client, and then I go for pizza with my girlfriends. The car is being used for dual purposes. So there's certain ways that you have to deal with your automobile expenses. The one thing I recommend is track them. Throw a book in your car, track your expenses for your vehicle, okay? Track your mileage for your vehicle, okay? Track the expenses, keep the receipts, all of the receipts, not just I filled up the tank and I had to go to this is the receipt for the gas for that trip, no. All the receipts, repairs, maintenance, gas, car insurance, CAA, hang on to all of them. Tolls and parking, hang on to all of them, okay? Not just for personal. You want to hang on to all of them, because depending on the method of how you claim your expenses, you may want to do a percentage of your gross, or you may do them per mileage. But it's important that you keep all your receipts and you can track your mileage. Now, as a special hint,
So I use the kilometer rate.
You have two methods of claiming vehicle expenses. One is easy. You just track your business kilometers, and then you can use the Canada Revenue Agency's per kilometer rate. Kilometers times that rate gives you your automobile expenses.
What's the rate?
I'll get to that.
I think it's 59 cents for the first 5,000 kilometers.
Yeah, it is broken down, so that'll be on the next page. The second way is a percentage of the actual expenses incurred. So you need to kind of decide what's more beneficial for you, or depending on how you like to keep records, you may just go with one or the other if you're not doing a lot of driving. If you're doing a lot of driving, then you may want the percentage of actual expenses may be more beneficial to you. Not so much, perhaps the per kilometer rate. Both require accurate records of business travel, okay? You either need a simplified logbook or a detailed logbook method. Okay, and I'll get into what those
That's
are.
your choice? Revenue Canada doesn't care which one you choose.
It doesn't matter which one you choose, the simple or the detailed logbook, okay? But, so you got a choice between here and here, and then you got a choice between whether it's a simplified or detailed logbook, unless you're a truck driver. Okay, then it gets a little, they really look for the detail. I recommend that on New Year's Eve or January 1st, you wake up, when you wake up after New Year's, pardon me, the night before, you record your odometer reading, okay? Every January 1st. Because then you will always have a constant odometer saying this is what the total kilometers I drove in the year, okay? Rather than having to, so that way now I can look at this and go, okay, this is January 1st, 2021, January 1st, 2022. The difference is my total kilometers for the year. And that makes it a little bit easier for figuring out that percentage, for that percentage calculation.
Even if you're driving your car for personal reasons?
Yes, you need to have, so basically when you're working out the percentage, the records that you need to keep are really a logbook of your business travel, okay? So if you take an odometer reading on January 1st every year, then you can actually just subtract and get your travel for the year without having to track every personal trip, okay? So then you have your business travel log, you have your total mileage, okay? So then you go and calculate the business use of vehicle. So if you decided to go on a per kilometer rate, so you've kept your business log. Now the simplified log means that you keep track of your mileage for about 3 months or so, very detailed, and then you extrapolate because it's going to be the same almost every month for the year what it would be. Okay, that's what a simplified method is. Works better with a percentage. When you're doing percentage, so I keep track of my mileage for January, February, March, and I find out I drive my vehicle for 30% of the time. I can assume that I'm going to be using it 30% all year round. If you have a varied travel, so 1 month you could travel 100 kilometers and the next month you're traveling 20, I highly recommend that you do a detailed logbook and keep track of your every trip that you take. You'll leave the book in the glove box and record the mileage on every trip, okay? And a reason for the trip in your logbook, because what Canada Revenue, if they choose to question your mileage, that's what they'll want to see. Okay? So though you have the ability to claim simplified or detailed, depending on how you are claiming your mileage and how regular your mileage is, you may find that one is more beneficial to you than the other. So the per kilometer rate changes every year. 2021, 59 and 53 cents. So everything up to the first 5,000 was 59 cents a kilometer. Over 5,000, you're allowed 53 cents per kilometer. For last year, we're looking at 61 and 55. And of course, for 2023, we're getting a little bit of a nice bump up here to 68 and 62 for this year. So if you haven't been tracking your mileage, now's a good time to start. Okay?
That's because the gas prices keep jumping all over.
Well, it is nice when they do that. When we get this, but we're getting this jump up.
61 to 68, wow.
Yeah. So that's there. So that's the per kilometer. So the first 5,000, you got this. Over 5,000, you start claiming this. Okay? And the first 5,000 is from 1 to 5,000, so you start with this rate at 5,001. Sometimes that can be difficult. Yes?
So with doing it this way, do you have to keep track of every single automotive receipt?
No, if you're doing it this way, you don't necessarily have to keep track of your receipts. You just have to make sure you have a good record of your mileage. And this is where I would recommend keeping track of your mileage every day, every month. Yes?
So I will tell you later, but my daughter has shown me, it's called iMile, and it tracks even if I'm not in my own car, as long as I've got my phone, it tracks my mileage, and I can check whether, I can swipe whether it's business or personal, and it's amazing.
Yeah, there are some very good tools out there to track your mileage.
Oh, yeah,
So if you're good at technical, that.
because writing down isn't gonna happen with me.
I've been doing it for a while, so, I'm still a little old school, but yeah. For the actual expense method, you're determining the total amount of kilometers driven for business, which is why you say you have to keep that record. And then you determine the total amount of kilometers driven during the year. Then you calculate the percentage, which is your business divided by the total, and then you apply that to your vehicle expenses that need to be allocated. Now, this includes things like insurance, interest payments. Now, you cannot claim principal on a payment. So if you're just bought a car and you're paying $200 every 2 weeks, only the interest is tax deductible, not the principal value of the car, okay? Only the interest is deductible as an automobile expense for our purposes here, okay? The actual cost of the vehicle is a depreciated expense should you wish to take that route with your vehicle. And then you have to, and that would be if you're not doing the per kilometer rate. You can depreciate it. Canada Revenue basically came up with these numbers as to the cost of using your vehicle, so you can't claim anything additional, except for tolls and parking. So if you're paying for parking, or you took the 407, those are due as additional expenses. Okay? Okay. So, I'm not getting into the details of depreciation for the purposes of this, because usually as a sole proprietorship, it only applies to larger purchases. So, but if you have questions about that, you're always welcome to give me a call. Business use of the home. This can be an interesting subject, especially if you're working from home and you're employed by ABC company and you have a certain home. There's certain restrictions on office space at home when you're doing it for another company, okay? When a company tells you you're working from home, they have to supply you with certain documentation. There's only certain expenses you can claim. There's a few more you can claim if you're a commission salesperson, but as overall, the expenses are limited and you need a specific form from the employer in order to be able to claim this as home expenses. The other thing is that you have to have a dedicated space. Okay, so if I was working for ABC company and they said I can work from home, in order for me to claim work at home expenses, I have to have a designated office. You can't be the kitchen table. However, if your primary place of work is your home, and you have a designated space, such as your office, or the basement downstairs, where you do work from, but when you're not working, it's used as for the kids or whatever, you're allowed to have that room used also for personal. If your primary location of doing your business is your home, okay? You don't have to worry about the fact that, on your lunch hour you sit and watch television, or in your office, or your kids had a party in the rec room, in the basement downstairs where you normally work. You are allowed to still continue to deduct your business expenses, whereas if you're working from an employer's point of view, it has to be designated. So that's one of the reasons why it's nice to be sole proprietorship if you're working from home. Okay, the portion is determined as a percentage of the space within your home base that's used for business purposes. Records must be kept to reflect the total expenses for the year for the home, and the receipts must be kept as backup. Okay? So you keep all your hydro, all your gas receipts, file them, put them on your spreadsheet under business use of home expenses, okay? So your first step is determine how much of your home. Well, that's kind of easy. If you have a square footage of the room, for example, a 10 by 12 office, and you have a 1,200 square foot home, then 10% is business. This does not include a basement. So if it's a bungalow, it's just the square footage of the top floor, like the main floor. You don't include any, even if it's a finished, beautiful basement and your office is down there, you only include You don't include the office and the basement in your square footage calculations, just the first floor. So decisions by committee. Actually,
Does it matter if you rent or own your own?
no. A rent paid for a residence, such as living in an apartment, and you have a 2-bedroom apartment and one of them is for business, you can still deduct a portion of the rent that's related to the square footage for your office.
So if my office is upstairs on the second floor,
Well, in that case, you do need to, any above floors have to be counted in the square footage. So, for example, 2 floors, maybe 2,000 square feet, the office is 200 square feet, so, okay. This calculation is, once you've got your percentage, then these are some of the expenses that you can claim. All right? Your heat, your hydro, electricity, insurance, maintenance to the home, mortgage interest, property taxes. Okay?
I thought we didn't have mortgage interest here in Canada. I know they have it in the States.
As a business expense, you can claim your mortgage interest, yes. As in the States, you can actually claim it as an itemized deduction as an individual. Okay, so, and it's now limited, but anyway, but yeah, mortgage interest. So you can claim interest on the business, for example, you have a business bank account and there's interest or bank fees. You can claim those as a full deduction against your business. But the mortgage interest on your home, that's a percentage. The insurance on your home, that's a percentage. Okay, it's a percentage of that expense. You cannot deduct the initial payment of your home. Right, that's your principal. Okay, you do not want to, you can't deduct the monthly payments if you're paying off a mortgage. You also can't, I also do not recommend claiming depreciation on your residence. Okay, and if you want to know a little more about that, if we have time, we'll discuss it, but I don't recommend depreciation. Maintenance of the space you're working in would be a business expense. For example, if I have to repair the wall in my office, okay, or I paint my office, that's can be directly related to the business. Maintenance, if I have to get the whole house sided, that would be more of a percentage expense of house repairs. Okay, this doesn't include replacing the roof, which is actually more of a capital expenditure.